Hello, members, one and all of the Salivation Nation. Everything is up, and who sets the price? Well, it's a good question because we've seen today record highs. The Dow is over 25,000. S&P, everything's up everywhere. Oil is up, gold and silver are up, commodities are up, everything is up. It's kind of crazy. So why? What's going on? Well, I can't answer every single question here, but we may have a hint here with this article that has come in from ET Markets, and this is an op-ed page here that talks about this article here. Who sets the gold price? This could change your outlook for the yellow metal, and it's an opinion piece, but we'll kind of see how it plays out, and it may provoke some thoughts and give us a little insight, perhaps. So this is by Asif Hirani, and it says, when I was in college, my economics professor taught me that price is dictated by demand and supply, or supply and demand. Many individuals give reasons to buy gold as demand for the yellow metal is expected to increase during the Indian wedding season, Diwali, and because of buying by central banks. So where does the international gold price come from? Where is it derived? There is no clear answer, but recent research shows gold prices are derived from the London over-the-counter spot gold market trading, and COMEX gold futures trading. It means international gold prices are set by paper gold market and not by the physical gold market. One should understand that supply and demand for physical gold plays no role in setting the gold price in COMEX and the London OTC market. Other markets such as Shanghai Gold Exchange, Multi-Commodity Exchange, MCX, and even physical gold markets worldwide are predominantly price takers that take in and use gold prices established by the paper gold markets in London and New York. A food for thought for those poor Indian jewelers or investors who hoard gold before Diwali, anticipating a price increase due to an increase in demand. According to BullionStar.com, the London OTC market predominantly involves trading of the synthetic unallocated gold, meaning trades are cash settled. COMEX is a derivative market where gold is traded in futures, and 99.95% of trades are settled in cash. Only 1 in 2,500 gold future contracts is settled in delivery. Very less physical gold is delivered to COMEX warehouse, and even less gold is withdrawn from it. It's very interesting indeed. What does unallocated gold mean? Unallocated gold is the gold that remains the property of banks, and investor is the creditor of the bank. This gold is rarely exercised, and most banks do not own sufficient gold to back the total value of unallocated gold investment. So large amounts of gold of trade done in London OTC is of gold created out of thin air, as this paper gold is only fractionally backed by the physical gold. Quite interesting indeed. So even our precious metal prices are basically contrived out of thin air by these trades. One interesting trend we are seeing is the rise of the EFPs, exchange for physicals, in the settlement of the COMEX gold futures contracts. According to CME, EFP, or exchange for physicals, is a privately negotiated transaction resulting in simultaneous exchange of exchange future positions for a corresponding position in the underlying physical, meaning the contract can be settled other than physical contract, like delivering comparable to US dollar amount of GLD shares instead of giving physical gold. In short, if the buyer in COMEX exercises his right to buy physical gold, the seller can fulfill the obligation without delivering actual gold. Sellers can short without any fear of delivering gold. This year, on June 26th, gold price fell 1% from $12.54 an ounce to $12.42 in a matter of seconds. Trading volume was 1.8 million ounces of gold, which is equivalent to nearly 59 tons, about 2% of the entire gold mining production of the world in a year. And there you see the chart showing that dip and the spike in volume. If the entity had sold 59 tons of physical gold shorts and had to make delivery, no way could any bullion bank or dealer do it without sourcing from other banks, and that too within a stipulated time. Ultimately, the seller would default on the contract and face legal lawsuit. But with paper gold, it's not a problem. We just pick up the phone and call our dealer and start our terminal and short sell gold. We can sell $1 billion worth of gold and paying just $50 million margin amount. So we have destroyed the price of gold without any physical gold involved. This is just a small example. We have seen many instances of flash trade this year where huge lots of gold were sold when the market volume is thin and the impact the scene straight away. So very interesting. The article continues here and it talks about the futures market and hedging, but I think the moral of the story here is that, it's there's a lot more paper, and that basically the trade for gold is really not based off the physical and the demand. I think that's the takeaway here, and to see how it's traded, what the prices are. So it's almost all artificial, which means that the actual physical metal, most people don't really care to take delivery of for those who are investing in the futures and the paper. And I bet the same can be said for the silver market as well. Although silver is a little bit different because it is seen more as a commodity and with any kind of futures trading, but it's quite interesting indeed. I do believe that as the article finishes here, it says that in spite of the regression of gold prices with the help of paper gold, we can't help but be bullish on gold because the reality is there isn't any surplus between gold mining and demand. The deficit from mining and physical metal is compensated by recycled gold, so the fundamentals eventually catch up with price. Slowly but surely, gold has to go up. And I'm of the same mindset too, that I think we are going to see gold continue to climb in price, and hence my prediction for this year on gold going up. And I think that's been steadily the rate throughout since gold was really tracked or a part of the COMEX or what have you. And we've seen gold essentially steadily climb up through the years. And that's kind of what it's supposed to do. It's a physical asset that provides a level of stability in times of economic hardship. And I think this article kind of backs that up. Quite interesting indeed, but it just kind of gives you an insight and a sort of realization here of what gold is. And the physical is really where it's at. When you hold it in your hand, you are holding it at a fraction of the price of what probably the price should be. So I hope you enjoyed this video. I'd like to extend a multitude of gratitude to y'all for watching and encourage you to please rate, comment, and subscribe.